Focus. Ideate. Innovate. Enable. KPMG ESG Conclave and Awards 2024 in partnership with CNBC TV 18. The second edition of KPMG in India's ESG Conclave and Awards 2024, honoring leaders in sustainable business practices, continues. An illustrious panel of experts deliberated on the topic, enabling green and inclusive growth, and shared remarkable insights on how governance frameworks and board oversight, coupled with regulatory and policy actions, can drive sustainable and equitable development in India.
Let me first look at the role of the board when it comes to promoting and enabling green and inclusive growth. So, Kalpana, let me set the stage by looking at the fact that calls for a great reset of capitalism. I might sound a bit rhetorical, but that's what the situation is right now. The calls for a great reset of capitalism have grown exponentially, especially since the pandemic proved that a reset of social and economic foundations is possible. So when we look at the situation currently, the escalating risks, whether it's for society or environment, which have been highlighted by the global risk reports of the World Economic Forum, I want to get your view on how the role of boards are evolving in India, especially for those companies that are looking to leverage more from this ESG journey, whether it's differentiation, whether it's innovation. What would you have to say?
So I see three distinct stages of evolution of boards in India. I would say about maybe 7-8 years ago, it used to be soft nudge by some independent directors. Maybe the CEO was passionate, is to say you need to focus on sustainability, diversity and inclusion, equity involved in that. Governance, as you know, ever since Sarbanes-Oxley and, even before that, Naresh Chandra Committee, etc., I think has been a part of the overall Indian corporate ecosystem. But that nudge from 7-8 years ago moved to the second stage when the regulators initially made it optional and then made it mandatory for companies to report on sustainability. And therefore, from a soft nudge, it actually migrated to mandatory compliances. CFOs grumbled about it, the finance departments grumbled about it, but we had to do it, so we went ahead and did it. The key change that I'm seeing over the last 3-4 years is twofold. One is companies are recognizing the risks involved in not facing up to what's happening in the climate space, the risk involved in not being socially aware of what's happening in your community, consumers, the broader stakeholder plate, rather than just looking at delivering returns to shareholders. And the second, and to my mind, the most important trend is how this is actually paying the companies to be innovative. You're seeing more and more within your regular operations how innovations is actually either adding to your bottom line because you're being more efficient, or you're coming up with something completely new which is adding to your top line as well as your bottom line. So these are the three kind of stages that I see.
Mr. Mahapatra, I want to understand from you as to how you view, considering your vast experience, on government leading by example, especially when it comes to ESG investments or policies, so they are coordinated, and of course the impact is greater than the sum of its parts, which benefits communities and constituents. Your thoughts?
Over a period of time, we have come to learn that from 2012 onwards, when we had the first implementation of the BRR, to 2021, we had the BRSR. Then there was another BRSR core coming in 2023. And now there is a rethinking on the core and the compliance requirements, whether they are too huge to be modified for the purpose of ease of doing business, etc. I believe, the policy trajectory and the policy impetus between economic and financial legislation and a social legislation, I would say ESG is a total social legislation, that the policy of the economic legislations should not be applied here.
You believe it should not be interconnected.
Right. We should be starting with a low threshold, because this is something which will change the habit. This will bring about transformation of the attitudinal approaches of corporate how to do business. We should have started with a low threshold and gradually increase it to a higher thresholds. So the point is, we are still trying to come to terms with the whole concept. So at this point in time, when we are putting out the legislation or the subordinate legislation, let's be very specific.
All right, sense and sensibility, the need of the hour, and keeping with the theme of the event, which is reflect, adapt, and of course evolve in real time. Let me evolve this conversation to the investment community side of what they think about all of the issues that we are discussing here. And Amit, I want to understand from you, how have your benchmarks evolved, especially from a returns and an impact standpoint, when we look at an asset's potential net zero journey? What would you have to say?
What I find interesting, and I'll just, before I jump into where the investors are at this moment, I'll kind of jump into where the corporates are. And I would say that they've actually progressed a lot. And I've got some statistics in front of me, which is 60%, and we looked at data for the top 200 companies. 60% use GRI or SASB disclosure standards. 48% use CDP or TCFD frameworks for sustainability disclosures. 69% have published an integrated report or a sustainability report. So if you're kind of looking at it, I'm saying that I feel that companies have been doing a fair amount as far as sustainability is concerned. As far as investors are concerned, I would say there is still a knowledge gap. Now, there were clearly two approaches which we could have had. We could have, one we've adopted is that one size fits all, and therefore all companies make a similar set of disclosures. From an investor perspective, what they've chosen to do is they kind of break it up into different industries. So they will kind of put together all the banks and finance companies and say, what is it that we need to focus here? They put together the manufacturing, and depending on the sophistication of the investor or the quantum of their investment, or I will put it another way, when did they begin on this whole ESG integration journey? If it was 4 or 5 years ago, they might kind of break it up further from manufacturing to say that, okay, we look at cement separately and we look at, power generation separately, et cetera, and then kind of have benchmarks. Now, for each of the industries or each of the businesses, there will be different ones. So just to give you a simple example, so if you're looking at, let's say, the power generation sector, you would look at a company and say that, what is the mix between coal and renewable? What is the carbon intensity? Is it coming down or is it going up? So the investors are kind of getting a lot more
granular information.
That's right. On governance, we know that companies with better governance tend to outperform during bear market phases rather than bull market phases. So coming back to what I said, the volatility, of course, we expect will be much, much lower for companies who have better governance practices and who embrace E, S, and G more wholeheartedly.
So in trying times, we actually get to see what's the true worth of the company and whether their ESG initiatives are bearing fruit for them and helping them withstand that volatility.
That's what we expect. That's what we expect, using governance as a proxy.
All right. Sai, let me get you in to comment on that, on what Amit has mentioned, and also take cues from some things which we spoke about last time, where you mentioned that the one key element missing in the Indian context when it comes to ESG is an integrated view in terms of impact when it comes to climate and social change, and how it has an impact on the company's financial performance. So considering all the chatter, so what Amit has mentioned, especially on the energy sector, right? I'm thinking about the stranded asset risk. There's a lot of chatter around that, and agriculture, the same issue. How do you see companies communicating and improving the way, how they communicate these risks and of course the impact that they have, because especially if large balance sheet in a net zero world are going to become useless. Your thoughts on this?
Companies are starting to do a number of things. They are starting to make commitments, be it a net zero commitment or in terms of, let's say, committing to abolish child labor in their entire supply chain, or let's say moving on to sustainable sourcing and so on. So as companies make each of these commitments, now the key thing to look at is how do they actually follow through on those commitments or those announcements. Now, these are kind of embedded within press releases that they put out on their website, on their annual report, and so many other glossy documents that they kind of come out with. Now, the key thing is there consistency between one, what is being stated and the action on the ground, between what is being stated in all of these documents and, let's say, the financial statements, which in a sense is...
it's not just window dressing.
Yeah, in a sense, because the capital markets ultimately function on the basis of true and fair financial statements, right? So if a lot of these commitments that are being made are ultimately not getting reflected appropriately and in the numbers which are kind of driving the capital markets, then again, I think there's a big disconnect. And therefore, I think it's important for companies to step back and see what they need to start doing. And again, in the context of these awards, I think we've looked at data for 400 odd companies. And we've also, in some of the contexts, I think, been looking at it now. There is an issue here. Now, when I look at it, like I said, there are commitments being made, but is there adequate disclosure in terms of the concrete actions that are being taken on the ground? I think those disclosures at times are found to be wanting. And in some cases, maybe it's not even happening. And which is where I think that importance of embedding some of these into the strategy and into reporting, I think, becomes extremely critical. And lastly is just the extent of information that is being put out. And in a sense, ultimately seeing, is it all getting linked back to the strategy? Is it actually kind of relevant and so on? So, and I think an important element here is also the reflection back into the financial statements, which is, I think, the crux of the question that you asked. And this is where, again, I think there's a huge gap in terms of recognizing climate risk in financial statements, or, for instance, the uncertainties associated with some of the other social commitments that you're making. I think that is not getting adequately reflected. Let's say a company is in a sector that is highly impacted by climate risk and says that, okay, because of all my peers are saying by 2035 it will be net zero, they also make that commitment. Now that commitment of net zero, which essentially means that it's the next 10 years that they got to do that, it means essentially that they got to make significant amount of investments to make that transition. It also needs to look at whether the current set of assets that are on their balance sheet, is the life only the remaining 10 years? Do you need to reassess the life of that? Again, as investors look at the kind of cash flows projected, is it going to generate the same level of cash flows that was previously envisaged and so on? So I think this goes on to raise a number of questions in terms of, I think, the valuations of companies, in terms of looking at the impairment, at times even looking at the extent, the going concern kind of assessments behind some of these companies. So it's not just about making a statement, but backing up that statement with tangible action and related disclosures, so that I think the ecosystem is able to holistically appreciate this.
All right. I guess on that note, it's time to conclude our panel on enabling green and inclusive growth. Thank you so much to all of our panelists for providing us the bird's eye view on how the stakeholder ecosystem is evolving. Thank you so much for your time, and thank you to the audience.
KPMG ESG Conclave and Awards 2024 in partnership with cnbc TV 18. Before the winners of the ESG Conclave and Awards 2024 were announced, the eminent jury members shared their take on the meticulous and objective selection process and evaluation criteria to recognize the deserving winners.
We need to reduce conflict and increase cooperation in all the non-military activities that we have in the world. Global issues such as capital and trade flows, monopolies, taxation, competition, data, social media, AI, and genetic and molecular biology. Unchecked, they can cause havoc, and hence the need for regulation. And I feel once again that corporate leaders are best positioned and most knowledgeable to make these things happen. And hence these awards.
Now for the most eagerly awaited segment of the evening, the ESG Awards. So the winner for the large cap category, Energy and Natural Resources, is the Tata Power Company Limited. For the next awards category, which is again in the large cap category for financial services, and the winner is Yes Bank Limited. Thank you and congratulations. The next category is industrial markets and automotive, and the winner is Hindustan Zinc Limited. Thank you, Mr. Bhatt. Now I'd like to invite Kalpana Morparia and Nilanjan Ghosh to join Yesi as well as Minister on stage. Thank you so much, Mr. Bhatt. The next large cap category is technology, media and telecom, and the winner is Wipro Limited. The next large cap category is consumer markets, and the winner is Hindustan Unilever Limited. And Mr. Ghosh. The next large cap category is pharma and healthcare, and the winner is Dr. Reddy's Laboratory Limited. The next large cap category is infrastructure, real estate and logistics, and the winner is Godrej Properties Limited. Much. Now moving to the mid-small caps category, and the first category is technology, media and telecom, and the winner is Cyient Limited. The next small and mid-cap company segment is consumer markets, and the winner is Wellspun Living Limited. The next mid-small cap segment is pharma and healthcare, and the winner is Jubilant Pharmova Limited. The next category is in the small and mid cap segment is financial services, and the winner is Grameen Limited. category in the mid-small cap segment is infrastructure, real estate, and logistics. And the winner is Chalet Hotels Limited. We actually have a joint winner for the infrastructure, real estate, and logistics category. And the other winner is Mahindra Life Spaces Developers Limited. Thank you so much. The next and final category in the mid and small cap segment is energy and natural resources, and the winner is DCM Shriram Limited. Thank you so much once again, and please join me in giving another big round of applause for all of our winners. Thank you all. It's been a truly inspiring evening.
KPMG ESG Conclave and Awards 2024 in partnership with CNBC TV 18. Focus, ideate, innovate, enable.